Good afternoon, everyone. Thank you so much for joining another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. And on today's webcast, we will be pleased to provide you with a brief macro overview. And of course, at the tail end of the conversation, be happy to address your questions. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up in the Q&A or the chat via Zoom. And on this beautiful summer afternoon, the 1st of August, I turn the conversation over to our very own Chief Investment Officer, David Burrows. Good afternoon, David.
Hi, Pamela. How are you?
Great. Here we are in August.
I know, it's amazing. I looked at it the other day. I realized that 3 months of the summer season, if you start at the beginning of May, is done. We got 3 months to go to get to the end of October and Thanksgiving. It's really quite something. Hey, thanks everybody for joining us today. Lots to talk about. You know, often markets go to sleep in the summer. They really haven't done that this year. It's been busy. I think lots of people have been spending time trying to figure out, you know, where their positioning should be, how invested they should be, and how to get over this view that we're headed into some kind of very difficult recession. Market certainly hasn't been showing that. We really like to take our read from indicators within the market, as opposed to saying this is what we think should happen. Our job is to understand sort of what is happening and make sure that our portfolios are positioned accordingly. So this is always an important part of our process, getting ready for this webcast each week, because at the end of the day, we're trying to be transparent, trying to be clear about exactly where we are positioned, and how that jives with what we see going on in the market, what we're seeing in our quantitative indicators, and if in fact anything needs to change. So with that in mind, you know, I like to always start from the top, and just take a broad-based view from an asset class perspective. If our view is that ultimately our job is to have a tailwind in the asset classes we're focused in, you know, we want to understand first and foremost, are we in a structural bull market or a structural bear market? When I say structural bull market, I mean long-term in nature, when an asset class gets revalued over a long period of time, like the US stock market did in the 1980s and 90s, where it was up just about 18% a year. But there was some sizable and difficult corrections along the way. You know, notably 1990-91 was a very difficult recession, and the market was down about 25% at the worst point. Took about 18 months to clear and make a new high. But once you did, of course, you had, you know, 3.5 years where the market rallied at very low volatility, you know, similar to what happened after the 1987 crash. And so as we've tried to highlight, you know, so long as we stay above this rising 200-week moving average, we continue to be in a long-term bull market. It looks very different than what a structural bear market looks like. During this period, multiples contracted in the S&P dramatically. Actually, cash flow quadrupled over this period of time, but the multiple investors were prepared to pay fell as they went to other places. And frankly, during that period of time, emerging markets had a great run. Commodity prices had a great run. So, you know, you had to recognize those shifts. In our case, you know, we spent most of that time focused on things like energy, but also in income producing assets, companies that had an inordinate ability to raise their dividend. That's when we really built our tactical income strategy. So as it sits, you know, US bull market kicked off in 2013. We think that we continue to be in one. We've been in the little bear market that we were in over the last 19 months since the beginning of 2022. We're still about 4% from the highs. My guess is at some point over the next couple of months, we'll clear those highs. It may not be right away. Of course, it could be, but certainly things are working their way in the right direction. When we look at the S&P 500 in a demographic form, it's really interesting. If you go back to this period here, 80s and 90s, a lot of this was driven by the baby boom coming to an investing age and peak earnings and consuming. And we've spent a lot of time talking about how the baby boom are moving along. I think I'm the last year of the baby boom. I was born in 1963. And so I'm coming up on a big birthday, but a lot of boomers are, you know, a lot further along. If we look at the cohorts that follow us, the millennials and Generation Z, Generation Z, we can see that both cohorts are working their way into their prime earnings years. So the millennials are really fit between 27 and 42. And over the next number of years will be in their peak earning years, which could help explain how it is that this bull market could continue for quite some time. You know, we're so far about 125 months in. The bull market in the 80s and 90s was closer to 220 months. We're up about 203% versus 1,300% in the 80s and 90s. And so this could go on a while. So here's the S&P. We are at 16-month highs. It was a very strong run that started really around the early part of May, and markets really have run unabated. In fact, up to the end of last week, there was an 11-day win streak, which is unusual, doesn't happen very often. I talked to a few folks who thought maybe this means we should let a little go. But if you actually look at the statistics, you know, it's actually pretty bullish. Slowly, people are becoming more bullish, and that's good. We are nowhere near where we were through 2020 and 21. We are nowhere near where we were 2016 through the later part of 2018. So people can get bullish and stay bullish for quite some time. 2013, 14, 15, investors got bullish and markets ran for 3 years. So I think it's good. People are repositioning. There's a lot of people behind the curve. There's just a ton of money that's gone into the bond market over this period of time. And when we look at those statistical periods where, you know, stocks have had, you know, good long runs, 11 days, they tend to happen in bull markets. And while we look 1 month out, you know, on average, market was up 2.5% from the point where the 11 days ended. And over time, up 80% of the time. You look out 3 months, you're up 100% of the time, 5 for 5. If you look out 6 months, you're up 100% of the time, 5 for 5, an average of 11%. If you look out 12 months, you're up 80% of the time, an average of 8%. So these things happen in markets when things are getting better. And as you know, we like to look for good getting better. Certainly, this is telling you things are getting better. So we talked a little bit about some statistics around non-recessionary bear markets since 1928, and this current one that we were in, which bottomed out around down 25% in the early part of October, 282 days, kind of fits the model for what happened in periods when you had a slowdown but didn't wind up having a recession. And certainly the data at this point does not support the idea we're in a recession. We're coming up on a 5-month, we just completed a 5-month win streak. When you've had 5-month long win streaks in the past, it tends to be that the next number of 3 months, 6 months, 12 months out again tend to be pretty good. So don't want to bore you with statistics, but the fact is we like to look at these things because our job is to understand what can happen. As it is in the Dow Industrial Average, it lagged until the late part of May, and you started to see a nice run in the industrials. We've talked a little bit about industrials over the last while, certainly acting well. And this certainly coincided with a lot of economically sensitive groups really picking up the steam. So over the period since March the 15th, when markets started to broaden out, we're pleased our macro portfolio is up about 16% to the end of July. Equity portfolio is up pretty sharply also. And that's helped by the fact that global stocks also have been outperforming. We've talked a little bit about what's happening in Japan coming out of a 30-year bear market that dates back to 1991. India coming out of a multi-year bear market. Mexico coming out of a multi-year bear market. Lots of global markets after a period of about 10 years of underperformance have really started to pick up the slack. And that's a broadening of the equity strength. It's not just the US. We're seeing strength across a whole host of markets in South America and in Asia. We're seeing strength in Europe. And this is important. It means that money is working its way into equities. At the same time, the flood of money into T-bills over the last 2 years seems to be ebbing. It doesn't mean it's coming out, but it means less money is going into T-bills. I think people got excited about the idea of getting, 4%. or 4.5%, look pretty good. Doesn't look so good when stocks go up that much in a month and leave them sitting on the sidelines. But there is a lot of money that can work its way into the market. Now, we talked about the fact that we saw a generational low in interest rates in 2020, and that was an important tell to us to maybe act differently. What worked in the 50s and 60s was really completely different than what worked in the last 40 years while we've had falling interest rates. Certainly, real estate was helped because it's a leveraged asset. The giant rise in private equity leveraged buyouts where they bought companies and added a bunch of debt with financial engineering to generate a higher return. Well, that's going to be tough with rates much higher. I had a very interesting conversation with a very senior pension fund manager last week who talked about the fact that it's a different world, that private equity is paying a lot more for debt, and it's going to have a big impact on returns going forward. So we have to pick our spots. Our belief is we need to own reflationary assets, things that do well in rising rates, because bonds aren't doing so well. This is the 10-year Treasury yields from 1981 through 2000, a sharp rise and cut through all of the moving averages, and then about a 12-month period where they kind of consolidated. But you can see 1, 2, 3, 4, the last 4 months we're working higher, yields were higher again today. And that means it's tough on all those folks who piled into bonds looking for safety. Prices are falling. This is the aggregate bond index from the summer of 2020. At the worst point, it was down 22%. Had a weak bounce through into the winter this year, and prices have been backing off since then. So again, people who expected a recession and expected rates to drop and expected bond prices to rally because they were a place to go to be safe have been sort of disappointed. You can see the US long treasury, the TLT ETF, again, today making multi-month lows. So we're going back now just about to the middle of last summer where prices were this low, and prices are negative on the year. So fixed income has not really been a place to be. So why is that? Well, for one thing, certainly the growth data has been coming in better than I think a lot of economists expected. Now, we've got to be careful of economists. They called, 14 of the last 9 recessions. But it may also have to do with the fact the US Treasury is just issuing a pile of debt. Since the debt ceiling was raised, they've raised $2.5 trillion in new issuance in treasuries. The expectation is they will raise another $2 trillion in the next 5 months, and that's got to go somewhere. We know that some of the typical buyers over the last number of years, the Japanese, the Chinese, certainly the Russians, are not buying treasury bonds, which means they're finding their way into domestic hands. And it may well be that there is demand for other types of assets. If people have been buying bonds over the last 2-3 years with hopes of a safety net, it's been disappointing. And so we think that money can rotate from fixed income into other assets that do well in a rising rate environment, like dividend growth equities and other types of assets that have pricing power. If we compare how it's going, stocks versus bonds, after a period last year that was rotten for both assets, stocks are clearly outperforming and they're working their way higher relative to bonds sort of week after week. And that's despite all of this money that worked its way into cash and bonds. If we look at the RDV, the dividend growers ETF versus the bond market, after roughly equal returns over 2022, again, the move that started when rates bottomed in 2020, where dividend growth outperformed bonds, dividend growth once again is outperforming bonds. So in our income portfolios, we're really focused on companies that have this inordinate ability to raise dividends. And there's a lot of companies in today's world that you might not think of, companies that are more economically sensitive, some steel companies, metals producers, energy producers that pay really good yields and trade at really low multiples, who have paid down debt and where you could see substantial dividend growth and earnings growth and maybe get a multiple increase in the valuation of the shares. Now we look at commodities, and we've looked at this over the last period of time, 2008 through 2020, a bear market. Prices fell dramatically. The energy sector fell 90%. A sharp rally off the bottom when we started to get a little more inflation. And through the Fed cycle, we had our first waning, our first consolidation of that trend. And this felt like a long time. It was 13, almost 14 months. But look what's happened over the last 2 months. Commodity prices have re-entered their upward price trend. And our belief is once you see a reversal in a bear market, a bull market could last a decade or longer and have a big impact on share prices of the producers. Certainly, we want to own companies that have the ability to raise price. And if supply demand is tight and things like copper, which we need in EVs, or steel that we need to build infrastructure, or battery materials to build batteries, they could have substantially growing cash flows. And we know that when commodities relative to stocks have underperformed for a long period of time and start to outperform, it can go on for a long time. Now, all that being said, with fears of recession, we know that investors were active in selling their commodity producers and commodity positions, and actually are as underweight commodities they've been in several years. So again, positioning matters, sentiment matters. And as you start to see these groups perform well, and they all started to lift in about the middle of March, you're seeing investors look back and say, we're underweight, we need to add some. So really important. We've seen a resumption of the uptrend in crude. This is crude oil prices from 2015 through 2021, a long bear market. It broke out and then consolidated while the Fed was raising rates. And frankly, while Joe Biden was selling off the US strategic petroleum reserves. But you can see we've resumed to move higher. But positioning exceedingly thin. The average portfolio less than in the 5th percentile of what would be typical for energy exposure. We've talked about different metals. This is silver prices going back to 2013. It's an industrial metal, consolidated after its initial move higher. In the last couple of weeks has resolved higher. Copper is doing the same thing. We traded through $4 yesterday and broke out on a point and figure chart. We'll see whether that follows through. My guess is it will, because so many of the commodities and global markets have had this exact same price pattern. Virtually all of them have resolved higher. We can see in the equities, which we'll talk about shortly, they already have started to move higher in anticipation that copper prices move higher. And so if we compare commodities versus bonds, long period of underperformance, a period of outperformance, the Fed tightening cycle, and we've broken out to the upside. So one by one, we are seeing these relationships resolve in favor of reflationary assets. Now, US dollar has been working its way lower since the bottom of the stock market as people took dollars and put it to work. It's interesting to see that we've had pretty strong commodity markets over the last month while the US dollar bounced, but we are below all the major moving averages. And my guess is somewhere in here, we probably fail and see the dollar move lower, which would be supportive of global stocks and supportive of commodity prices. So let's move forward. This is the macro portfolio from May 31st through July 31st, up about 15%. This is the equity portfolio. It's up about 9% over the same period of time. We're getting a good lift. So all of these themes seem to be starting to move. So talk a little bit about data. Probably the most important data over the last week was the economic data we got out of the US last Friday. This was kind of Goldilocks data. Expectation in the survey was for GDP growth quarter over quarter. 1.8% growth came in up 2.4, seriously stronger than what was expected. Personal consumption was expected at 1.2, came in at 1.6. But on the inflation front, GDP price index was expected to be up 3%, was up only 2.2. The PCE price index quarter over quarter came in a little bit lower. but durable goods orders came in well above what was expected. So what this points to is stronger economic activity and a little bit less inflation. That's good. It helps us to believe that perhaps the Fed is done with their tightening. Okay, so let's talk about leadership. We spent a lot of time focused on which areas from a top-down perspective we think give us best risk reward. We don't have to be everywhere. We want to pick our spots. We want to find groups that are seeing net inflows of capital where breadth is expanding. And then we want to find securities to express our view that fundamentally are sound and good getting better, where we could see a multiple expansion as investors recognize that something's changing for the better. We know that a big piece of our return comes from getting to the right neighborhood, the right themes and asset classes. So as we ticked off the top, equities, now global equities, commodity prices, commodity producers, and then find some securities that are leaders within those groups. Okay, the goal is in each of the sectors or themes we're invested in is to see over time a higher and higher percent of stocks participating in the rally. That means money is getting put to work. There's no way around it. That's quantitative. When we see breadth deteriorate, like the leaders continuing on, but the weaklings starting to peel away, that tells us we should be a little more cautious. And we run models on about 300 universes of securities daily to try to recognize change. When we see deterioration in breadth, our job is to reduce our exposure. It means that we should tighten up our stop losses, raise a little bit of cash, and not put any new money to work in those groups. Okay, so let's talk about breadth. As we sit, our key long-term indicators, percent of stocks in uptrends, and our key short-term indicators, percent of stocks trading above the 50-day moving average, percent of stocks with positive weekly price momentum, percent of stocks making new highs versus new lows, and percent of stocks trading above the 150-day moving average all continue to improve. So I've said before, there are no bear markets that take place while breadth is expanding. So there's going to be a week where I come on and we'll say, well, a number of our indicators have turned down. Who knows when that will be? And that will mean it's time for us to reduce some exposure. But at this point, we are not overbought in any way. This indicator, percent of stocks in uptrends, can get to 70 or 80%, meaning almost everything's going up. It's a highly productive time to be invested and can stay there for as long as a year at a time. As we sit, we're pushing closer to 50%. I think we're 48.5% for all US stocks and about the same globally. When we look at Canada, which has lagged from a breadth perspective, from a price perspective, this is April of last year. We were making lower lows and lower highs, June of last year, August of last year, October of last year, and then we reversed. Higher high into November, pulled back to a higher low, higher high into December, pulled back to a higher low, higher high into January, pulls back and tests. And here we are in the last week, we've just broken above all of these recent highs. This is the EWC, which is the ETF, known as Canadian equities, the largest one, and just broke a quadruple top to the upside. Again, that is the uptrend resuming. Let's talk leadership. In the beginning of May, the average sector had 43% of companies in uptrends. Notably, a number of the economically sensitive groups started to show improvement in breadth. The further along the spectrum we go, the higher the percentage of stocks in uptrends. So you can see the strongest groups in the market, quite economically sensitive in the beginning of May, and the weakest ones, some of the most defensive sectors, utilities, drugs, food, and so on. If we look at it as of the 31st, the average sector now 50% of stocks in uptrends. So moving to the right, we note that we continue to have many of the most economically sensitive sectors leading and some of the most defensive sectors lagging. A couple things I would mention: aerospace and defense for the first time showed some weakness over the past week. I know we got stopped out of Raytheon, which reported and disappointed. The semiconductor sector, which has been a strong group recently, did show some weakness under the surface, although the leading stocks continued to act well. We'll watch that with interest. So technology, the relative strength that started in January, rising relative strength versus the S&P is positive, has been basically sideways now since May. In other words, the rest of the market is playing catch up, but it's continued to act well. This is the XLK, made up of the largest companies, the mega cap stocks in the NASDAQ 100. I think the biggest position in the firm continues to be NVIDIA. You can see it's trading better than 99% of companies in the S&P over the last 52 weeks. It's had steadily rising relative strength. We're there. I'm always nervous when stocks have done this well, but it doesn't mean that that has to stop. AI is going to be a very big driver, and ultimately, at some point, there'll be a breather. We'll have to assess, but they continue to be the dominant company in expressing a view. If you want to be invested in AI, all of the companies that are going to want to put AI applications out are going to have to test their big large language models using computing power, most of it being provided by NVIDIA. Meta, an interesting way to play AI, is obviously leading and has had a great run. Thank you, James Callahan, our US equity specialist, for pushing us into Meta. And Adobe made a new 52-week high today, trading very strongly out of earnings recently. Palo Alto Networks, another way to be exposed to this theme in the security side, again, after a hesitation in the beginning of July, now turning and rallying and working its way higher. So this group continues to be a juggernaut. We continue to have about 20% exposure to tech, which is an underweight, but there's other things that we can do. Shopify, I suppose you can call it technology, you could call it e-commerce, but after a very disappointing 2022, really started to rip before the market made a bottom, and this is one that we're happy to own. So lots of good names in these groups. But I want to be clear, these are not the only companies to own. Industrials have just been on a tear. Industrials actually made their low prior to the October low in the S&P. They've been making higher lows ever since. This is an equally weighted ETF of industrial companies. It includes transportation companies, it includes machinery companies, it includes aerospace. We're making 52-week highs. We've taken out the highs actually prior to the bear market in December of 2021. We've talked about Finning, which continues to work its way higher. Of course, this is the distributor of Caterpillar equipment in Canada and South America, selling into infrastructure, which is really, really important, selling into the resource sector and selling into construction. Ingersoll Rand, another company which we've talked about over the last little while, performing really, really well. But the transports, as of the end of April, really started to lift and have followed through and are now making 52-week highs. Home construction, part of them industrial companies, some of them consumer companies, making 52-week highs. And materials over the last few weeks have broken out of the range they were in. And this is an important group. This is a group of companies that trade at very low multiples, have great cash flow growth, in many cases have paid down a lot of their debt, and have a great opportunity to raise dividends as we go forward. Now, a lot of it's being driven by the spending that's going on in infrastructure and this $1 trillion infrastructure bill in the US. This is an ETF made up of companies that do infrastructure development. If there's going to be a lot of infrastructure development, we're going to need a lot of materials. So we're seeing power grid infrastructure companies, which is machinery and engineering and construction companies, do well. We've talked about Stantec. The uranium companies are doing well because we're rebuilding the power grid. The US is lagging on the small nuclear reactors, but the rest of the world seems to be implementing. We talked about one of the companies in the US that could be a leader here. They make small reactors for US submarines. Stantec is performing well. It's an engineering consulting company. And then the metals producers, after a long consolidation, have started to break out to the upside. That's Freeport-McMoRan, Capstone Copper, trading very close to 52-week highs. These ranges go back to 2011, so long bear markets are coming out of, probably the beginning of long bull markets. And the steel sector making 52-week highs today. So there's a lot of different things to do. In Canada, it turns out that energy is pretty important. This is the FCG ETF that's invested in natural gas producers. Again, an initial move higher, a consolidation while the Fed tightened rates, and now the market looking beyond the Fed tightening cycle and companies in this group starting to work higher. We've got quite a number of natural gas producers here in Canada. This is a poster child. We talked about watching CNQ. Canadian Natural Resources, the big oil sands producer, has been in a bear market from 2008 through breaking out in 2022 and then consolidating. And this week we started breaking out above that range. So there's just so many great senior companies in this area. In the last bull market, Canadian Natural Resources went up 1,700% as it traded from just over $2 to just about $60. Now, a long bear market means that slowly people lose interest. And we know that pension funds and a lot of investors said we're going to move away from carbon-based energy. But the fact is we're going to need it for a long time. Canadian Natural Resources has over 50 years of reserve life. They've paid down debt to their targeted levels. It pays a 4.5% dividend, and the dividend's growing over 30%. This is a company that we could see earnings multiple expansion, a growth in earnings as they're paid down debt, and a sharply higher growing dividend. And we'll see what this next bull market brings, but this is what can happen. Oil services. Since the end of April, on a tear, we own companies like Secure Energy and Precision Drilling. We own Shawcor that makes pipe and equipment for pipelines. So lots of exposure here as well. Now, these are sectors that have not done well for a long time. They are not well owned. Schlumberger is probably the most important energy service company in the world, providing services all over the globe. Again, inexpensive, paying a good dividend, and one that should be able to grow its dividend along the way. Financial services has resumed its move higher. This is the capital markets ETF KCE. I think that's really important this past month, giving us a strong indication that they're resuming a longer term uptrend. So what does it all mean? Well, technology continues to be about 21%. At the beginning of last month, it was 22%, come down a little bit, not so much because we've reduced, because other sectors have started to play a little catch up. We've been increasing our financials weight. We're about 18% versus the index 12.46%. Industrials came down a little this week. I mentioned we reduced and sold Raytheon. That's what took this weight down. We've been increasing our energy weight just about 10%. Consumer discretionary is a little bit higher as we've done a little bit more exposure in online consumer. Materials is about twice the weight. It's up about 1.5% in weighting from the beginning of last month. And in the defensives, we continue to reduce our exposure: healthcare, communication services, real estate, consumer staples, and utilities. So this is an incremental process. Our job is to make little changes. Now, during the bear market last year, there was lots of volatility, and we probably got stopped out of more positions than we would have liked to. But now we've got a market that's starting to trend, and it's likely that our trade count would be substantially lower. The portfolios have really solid, and they are not seeing a lot of turnover. Volatility has dropped. So this is the peak in volatility in the COVID lows. We made a number of lower lows through 2022, and now we're in the bottom end of the range. So VIX is at 13. What does that mean? When you go through periods where volatility is low, that's what happens during the next bull market. This is 2016, 17, and into 2018, a very strong period of time for the market. 2013, 14 into 15, a very strong period of time for the market. We've just entered that low volatility zone, which means likely dips will be bought. I'm not saying this market's going straight higher, they just never do. But my guess is that there's enough money on the sidelines that if markets pull back, unless there's a real deterioration in the economic data, dips will be bought. So bond investors are still very, very nervous. Volatility is high in bonds, but it's low in stocks. Last couple of points. Credit risk. Expectation or fear that credit investors might be hurt by defaults. The excess return that bond investors were expecting to own corporate credit, either investment grade or high yield, is coming down, meaning they're demanding less by way of a premium to buy corporate debt. So look, October turns out, I think, to have been the low. We've been working our way higher since then. Economic data is coming in stronger than what people expected. It may turn out that the Fed was right to be as aggressive in their tightening, and that the economy perhaps could handle it with all the excess cash floating around. As we come up on this old high, it's possible we chop sideways a little bit, but we think there is new leadership that favors economically sensitive groups and reflation. What comes after bear markets are long run-ups in price. And that is our expectation as to what we see over the next 2 to 3 years. If things get more difficult and Brett starts to back off, we will get defensive. And you'll hear me say the indicators are changing, but as it stands right now, it supports our positioning, and there's very small adjustments to be made. But importantly, the market has really started to broaden out since the end of March, and in particular since May. And that's probably the beginning of a longer term bull market. So with that, Pamela, if there's any questions, certainly I'm happy to answer. Don't hesitate to follow on Twitter. We're putting up a fair bit of, I guess we have to call it X now, a fair bit of content, and hopefully it's useful. Pamela, any questions?
Thanks, Dave. This afternoon, we don't have any questions, so I'll leave you with the final word. Thanks again for a great update.
Well, hopefully there's a bunch of people at the cottage. Hopefully there's a bunch of people that are golfing or playing tennis and getting some exercise. It's nice here to have a little warm weather. We'll be back next Tuesday at 4 o'clock. If you got any questions in the meantime, don't hesitate to reach out. If you've got any concerns, things you're worried about, we're happy to talk. And we appreciate your attention and look forward to seeing you again next week. Thanks, folks.